a huge run-up in money that's run into the private equity or private capital space. And Bain had a very interesting study for the first half of this year. And I think over the last 5 years or so, it's been like $6 to $7 trillion has come into the space. So if you have that much money coming in, you need a much bigger exit window on the back end. Not only the exit window not getting any bigger, it's now nailed shut.
Welcome to the Land and Everything Else podcast. I'm Dr. Craig Lemoyne here today with Bill Kelly, CEO of the Kaya Foundation, and I may have said that wrong. So Bill, go ahead and introduce yourself a little bit.
Hi, Craig. Thank you and appreciate you having me on. So Kaya does have a foundation that is geared toward bringing greater levels of diversity into this industry, started by PAMCO way back when, but the primary business that I'm in charge of is the association. We operate in concert, but Kaya Association is about a little over 2 decades old. We're a credentialing body, but maybe more importantly, as we move toward digitization, democratization, the investor at the window is more than just the sovereign wealth fund or the sophisticated public pension plan or the endowment and foundation. And we have to have educational solutions for all comers. So we're trying to democratize education before product. We do that through our curriculum, which we now have about 14,000 members in 100 different countries, probably about 6,000 people sitting for that exam annually. But we have a whole host of content on our platform, and we have a Unified by Kaya platform that my colleague Aaron Philback rolled out with a series of micro-credentials. So we are not trying to be all things to all people, but when it comes to education in the alt space, we are trying to have that arc bend a little bit more toward the client and the investor.
So the Land and Everything Else podcast, we really do try to look at that intersection between retail, wealth management, financial planning, and non-stock and bond investing. So I'm absolutely thrilled to have you on today. And I guess I want to start our conversation and tell me a little bit about your story. How did you get where you are? And I'd love to know a little more about your career.
Sure. So I'll try to give you the shorthand version because it spans hard to say and believe, but it's now, I got out of college almost 45 years ago. So it's awesome. Quite the stretch, but I've had the great fortune of having some great opportunities, some great mentors. I would say the vast majority of my career is financial services. I started with Price Waterhouse. I got my CPA right out of college. Learned how to read a balance sheet, worked on some financial services companies, but some completely out of the industry as well. But then a short stint at Bear Stearns, which finished up my tenure in New York, moved to Boston in 1988. And it was there that I probably really got involved in the buy side of asset management. I worked for the institutional money management arm of the Boston Company, which was owned by Shearson, Lehman, American Express, and then Mellon Bank before it became BNY Mellon. So a series of owners. I learned a lot about the business through each one of those movements around shareholder engagement through these institutional owners. But then a group of us left to start a firm called Boston Partners de novo in 1995, not a paperclip to our name. And we ended up creating a very successful business called Boston Partners. We ran it independently for about 7 years, sold it to Robeco in Rotterdam. I became the CEO of the U.S. operation. It did that to the beginning of 2009 and then left on very good terms, did some independent board work. But as you might know, at least in the course of this discussion, Craig, and we've met before, I didn't have the temperament to be sitting there just as a director 4 times a year dialing in. And I really liked that work, but I wanted to be operationally engaged too. So a couple years later, the Kaya opportunity came along, and I've had the great privilege of serving this capacity for the last 11 years. And as you know, and some of the listeners will know, I'm retiring at the end of this year. So the very best job I've ever had, and I will miss virtually every aspect of it.
Well, I'm absolutely thrilled we have the chance to talk to you still in the driver's seat a bit longer, and what an amazing career. And I guess I'd like to pivot from that career and talk to you a little bit about the world of alternatives. You know, the impetus for this Land and Everything Else podcast is a grant through the College of ACES, and really kind of studying how we see alternatives both in the farmland world and real estate, but they're kind of dissimilating from what used to be a very institutional use, right? Like an insurance company reserve fund or a pension fund. And we're seeing them trickle from there to family offices, from family offices to CFP professionals, right? Like using them with clients. And I was wondering, over your amazing career, how have you seen the transformation of products? And I'd just love to get you to talk a little bit about that with me.
Yeah, it's a bit of an evolution, and I think I've used this line before. It's like falling in love slowly and then all at once, and I
Love that.
think the evolution and change was slowly for many many years. And the endowment model, which Dave Swenson gets his due credit for that, but it was started by the Ford Foundation with a grant to the Common Fund almost 60 years ago. So the
Oh
endowment
wow.
approach to investing has been around for a very, very long time.
Sure.
And if you think about the province back then of investing in a buyout fund, there were probably just a handful of players. The concept of asymmetric advantage was there. The concept of an illiquidity premium was there. A complexity premium was there. Dispersion was probably non existent, and it was a full on alpha play. Now it's gotten a lot more complicated. There's probably over 10,000 private funds in the marketplace as we sit here today. Dispersion has gotten very, very wide. And investors trying to find their edge, and if they're going to treat, for instance, private equity or farmland or timberland as an asset class as opposed to an opportunity to invest in something that requires a lot of due diligence up front, they're going to be more often than not sorely disappointed. So I think it's the growth that's driven this to a very large degree. I mentioned I started Kaya in 2013. And institutional assets, and I'll come back to it in a moment, institutional quality also, probably about 6 trillion. Today, they're probably in mid 20s and growing very, very rapidly. Still probably less than 20% of the global AUM pie, but more than 50% of the revenue. And if you're a traditional manager, and you haven't thought about it already, a movement toward alts is clearly the direction of travel, and we're seeing more and more of that through traditional manager channels as well as the alts channels as well. So the evolution has happened probably more, I would say, maybe in the last 10 years where things really started to heat up. But not only has the profile of the investor changed, and you talked about going from endowments and foundations to sovereign wealth funds to family offices, it's really moving toward the mass affluent. And as we do that, the definition of alts changes too. So, and if you think about institutional quality, it doesn't mean it's better, but it's more, if you think about CalPERS, a very large public pension
Sure.
plan,
Yeah.
could that invest in digital assets? Most likely not. Could it invest in wine or baseball cards? Most likely not, because they're so big, they
Right.
would capture the
Oh,
market by investing
absolutely.
in a
Yeah.
single fund.
Yeah.
So as you think about wealth management and maybe the mass affluent, I think it opens up the door to a lot more opportunities around collectibles, around art, around wine, around baseball cards, collectibles. So I think there's a lot of interesting optionality here. But again, you've got to separate hobby from investment. The concept of long-termism, regardless of the asset class, is very, very much in play. So if you're in it to make a quick buck in an illiquid asset, going to be very, very difficult to do. So it has been a very interesting 5 or 6 decades. I think it's moving in the right direction. And maybe I'll finish this question with this point. This whole democratization play, it's driven by clearly the funds themselves, the GPs, who recognize the individuals a dominant part of the AUM pie. They're a little over 50% now, and that's not changing. But then more importantly for you and I as investors, and I don't know what the university does for you. I can tell you what Kaya does for me. I have a 401k plan. You probably have a 403b.
I
Very,
do.
very pedestrian options. There's a matching
Right.
contribution, and the rest of it's up to me. But
That's
if I
true.
see that lending is now in the private markets because thanks to Messrs. Graham and Dodd, the banks don't lend anymore, and also capital formation is more and more happening in the private
Oh,
markets as well.
absolutely.
So
Absolutely.
we have to find ways of getting access. So it's critically important that we provide the right gateways, but easier said than done.
I absolutely love that. And one follow up to that end, when we look at the role technology has had in moving opportunities that the mass affluent didn't used to have those opportunities, have you seen that? How have you seen tech evolve over your career? What if there are moments you could kind of share where light bulbs went on, and how we've seen this role maybe more retail and a little less institutional as far as where someone can buy.
Yeah, well, I think in the course of my career, maybe in the early stages, technology was always a cost center. it was never
Okay.
integral to the decision-making process. And I think the concept of a CTO, Chief Technology Officer, or anybody along those lines, Chief Information Officer, CIO, were largely non-existent. Now, I think the smarter organizations are saying, I have all this data, and I'm
Okay.
still making process-based decisions, meaning
Okay.
I make that decision today because I'm following the same process I did yesterday. The
Sure.
smarter decision maker is going to the IT department and saying, I'm going to get you out of the bowels of a cost center and move you into the strategic decision-making process. And can we make better and more informed data-driven decisions? And I think that trend is starting and continuing. Some organizations are much more along the lines of that continuum than others, but we are long data. There's a tremendous amount of it out there. It's measured in zettabytes, which I think
Yes,
in
it's
10 to
crazy.
the maybe the 28th power. You could probably correct me
Wow.
on that. So it's
No,
a
not offhand.
massive number. And most of it has come into existence just in the last 15 years as a result of the iPhone. And every like, every tweet, somebody's got a digital footprint to this and is being recorded and weaponized and used to make decisions. So I see that evolution continuing, and I think it's going to be a problem solver, I believe, for democratization to a large degree. And I've heard, and maybe you've heard this as well, Greg, that distributed ledger or blockchain is a solution in search of a problem, and that may or may not be true. But I look at Bitcoin as an example, and with the approval of the SEC
Yes.
for these ETFs, we're seeing more and more movement in that space. But love or hate Bitcoin, it cannot be $1 trillion asset class without blockchain. The ability to have an immutable ledger that's open 24/7 was an integral part of the success of the
Well,
growth of that.
absolutely. It's the backbone.
No doubt. And if I then apply that to what is today and tomorrow's stock certificate, which is going to be a non-fungible token, that's my stock certificate. And if
Right.
that can trade immutably on a ledger, then I think we're on to something. It might have to be permissioned as opposed to permissionless, and we can get into what that means in a moment. But maybe a proof statement, and one for you and I and maybe listeners to look at, is that we've seen this a little bit, but Hamilton Lane is a recent example. They came out with a secondaries fund just within the last couple of weeks. I think it's about a $5 billion raise, slightly oversubscribed, which some of these funds still are today. And if you want to come in as an institutional investor, the
Okay.
minimum investment, I believe, is $5 million. I don't know about your family balance sheet, maybe a little bit rich for mine, but if they have a feeder fund on the blockchain, and in the
Okay.
feeder fund on the blockchain, you could get in for $20,000 versus 5 million.
Really?
So I think
Wow.
it's democratizing
It is.
access, and the GP is able to look at this as one ticket, one investor, as opposed to a series of 20,000 adding up to 5 million, which is the last thing the GP wants or needs in terms of their
Right.
infrastructure.
Wow. That's really cool to hear. And the way that the blockchain's being utilized in that
Yeah.
aspect, I think is that's really neat.
Yeah,
So
early days, but maybe just one last thing in that too. And this I would love to see happen. We've had these news stories about S REIT and B REIT gating because they're interval funds, and you hit 5% a quarter, 20% a year, it's game over, and the fund has to at least temporarily shut down. I'm thinking on the blockchain, if there was a price referee who helped with discovery and you wanted
okay.
in and I wanted out, somebody would have the matching. And if we like the price, the deal happens. If we don't, we don't. But the fund itself does not have to raise any liquidity, which I
Right.
think is awesome for the investor that bought into the value
Sure.
proposition, that doesn't want any liquidity happening around them, because the moment that happens, I've got a value leak out the window.
Well, I mean, and that's part of the why we're buying some of these alternatives. It's not like we want extra cash. There's this idea of, why am I buying this? What's the purpose of this asset? Where does it get me? How does it fit with my family goals, values down
Yep.
the line?
Yep.
I'd like to kind of pivot a little with you on, our audience is a fair amount of insurance agents, certified financial planner professionals, that investment advisor space, and some registered reps at brokerage firms. As we start to advise clients on alts, or they come to us with questions, where do I get more education? And is the Kaya for me? And how do I go about it?
Well, so the Kaya designation, as I said earlier, it's not for the faint of heart. It's
No, it's
about
rigorous, that's for
Yeah,
sure.
it's about 400 hours of study time. I went through it myself just a couple of years ago, and it is a lot of work. And I can say that relative to the CPA, relative
Yeah.
to being a level two CFA candidate. So it does take a lot of time. And if I'm running a busy practice, the last thing I have time for is to sit down for a high stakes exam. It doesn't mean you shouldn't be paying attention. So that's one of the impetus for coming out with this unified platform where we have 5 hour the micro credentials, a very good way of understanding sort of the 101, some of the vocabulary. It makes other articles approachable. It helps in due diligence to ask the right questions, hopefully understand the answers when you get them, asking the right follow-up questions. So to treat, as I said earlier, private equity as an example, as an asset class, or a buyout more specifically as an asset class, you're not going to be doing right by your end client, and due diligence is critically important. I was in Canada and I tried out a new line that I just posted on LinkedIn last week where the concept of diversification being a free lunch, I still think it's the case, but it's got a cover charge. And the cover charge is due diligence. And unless you're willing to pay that
Love
cover
that. I
charge and
love that.
invest correctly, you should not be coming to this asset class in the first place.
I think that's absolutely fantastic. I'm 100% in with that element. I do worry as we do have more, I don't know, mass affluent investors interested in asset classes that aren't traditional mutual fund, ETF style asset classes. I How do you explain and talk about illiquidity when it comes to investing? I tend to tie it to goals, like when was this money and when are we going to look in the future? But what's the conversation you train around illiquidity premiums when we talk about alts?
It's very difficult to do, and I would almost argue that if I look at the amount of dry powder today, and by many estimates it's 3 to 4 trillion, probably about a trillion of it's in the buyout space. Am I really getting an illiquidity premium in the first place? I would argue maybe, maybe not. But even if you wanted to build the case that you are, I think most investors don't understand what it is, and it's a very hard thing to prove with great precision arithmetically. So why are we going down that rabbit hole in the first place? So I think we've got to be talking to investors in language that they can understand that makes good common sense to everybody. And again, I'll point to Hamilton Lane because they put out another interesting piece of research a couple of years ago. And the threshold, I believe, was $100 million of revenue or more. So they went out and found every single company with $100 million of revenue, public or private. They added them up, and there was probably about 25-ish thousand companies.
Okay.
87% were private. So the tagline and the headline is capital formation and value creation is happening in the private markets, full stop. And if you go to the public market space, the small cap really exists anymore. I guess you could go and add up small cap companies depending on your definition, and the answer is yes. But does it have the same level of innovation as maybe early stage or late stage VC? Absolutely not.
Not at all.
So if you want innovation and access to some of the greatest ideas happening, oftentimes they don't even get to the public market. And if they do, the value proposition's been rinsed out. So I think there's ways of explaining this, but then maybe back, Jermaine, to your point, Greg, is that a threshold argument is long-termism. And we've got to take the time to sit down with the client and say, let's put the asset side of your balance sheet aside for the moment and look at the liability side. And what are your obligations near term? You have college tuition coming up in the next 3 to 5 years. If that's the case, do not go near private equity. Do not go near the private markets. You want that to be probably invested maybe more in fixed income, maybe some equity exposure, but you want to make sure you have access to those funds. If you're retiring in 2 years, that might be a different proposition than somebody who's 30 and not retiring to the 65 or 70. If you've got a ring of assets that likely your family is not going to touch, and this is the next generation, liquidity is not a page one concern either. So I think if we were able to partition off the liabilities and the call in those assets first, I think it sets the investor up with a mindset, okay, I don't really need this. And the same concept of buying a house. That
Sure.
you buy a house with a down payment. It's highly levered. It's got high transaction costs, very little price discovery. Sounds a lot like private equity. We've gotten
It does.
comfortable with that,
It
and
does.
we've gotten comfortable with an ownership that could be 7 to maybe 30 or more years.
Yeah,
So
I mean
the
that's
consumer
an
mind is
analogy I
wired.
haven't even thought of. That's a fantastic analogy when talking with people about private equity. I love that. I love the home buying. That's really clever. I love that.
Yeah, well, and I think it's not they're not exactly apples
No.
to apples, but I think it puts them in a mindset and
Yeah.
words and language they can understand. But at the end of this conversation, though, Craig, if you had this conversation, you've asked, you know what, I'm just not comfortable with it. Can you get me into an interval fund? I would say to them, you know what, I think you're better off with the public market beta because by the time you get the fees and liquidity rinsed out, the correlation public to private equity is like zero point 0.9. The median correlation is zero point 0.9. So if you're in an interval fund with nothing really special about it in terms of underlying GPs, and there's a quarterly leak in distributions of liquidity, you're not going to have a differentiated offering in the first place.
So on that note, this is my perspective anecdotally, and
Sure.
I think research might back me up on this, but I got into this industry in the late '90s and selling insurance and mutual funds for Lincoln Financial Advisors, and I loved it, and it taught me a lot about the world. I'm really happy I had that experience. I think it's made me a better professor, but it was very much about, okay, you want to buy these actively managed A share kind of stuff. And then we went into a world in the wealth management space where we kind of decided, well, maybe ETFs and cheap is better. And I think what it did was there was almost no value put on the skill in investment management, right? Like we can buy ETFs and build an asset class of 80/20 or whatever we're trying to do. But the more I've started exploring alts and private equity, the more you start seeing skill is tantamount, right? Like skill is like not only necessary but differentiating. And I just kind of wondered if you could talk a little bit about talent, skill, the demand drive for those things, and how that may be different than how we've conceived investing in the 2000s, 2010s.
Well, yeah, separating luck from skill is an important tenet for any investor, and we talk a lot about this in the Kaya curriculum. And I think to your point, I'm not going to be able to cite any study, but I'm sure there've been studies done on this. That if there's a successful first-time fund and that same individual GP is on the second fund and the third fund, there's high likelihood that that success continues to accrue to that manager. So that really then makes the challenge even greater in that it's not only picking the right general partner firm, it's getting the right GP inside of that general partner. And I think that is a critical part of the due diligence as well. But as I mentioned a moment ago, all of this dry powder, the biggest clog in the system has been in the buyout space.
Okay.
And the old adage that you don't get fired for hiring Blackstone as an example, I think that's true. And not to diss Blackstone, I'm just using them as an example.
Sure.
Are
Sure.
you getting a differentiated return in a space that's gotten very, very crowded, a lot more efficient, a lot more competition for the portfolio companies? And all of that starts to feel and smell a lot more like beta than alpha. Alpha is found in great pockets of inefficiency on
Sure.
pathways where nobody else is traveling. And what's interesting at this stage of the market, thinking about a different geography, we're entering into the secondary market. So maybe looking at a GP that might be in the small and mid cap space might extract a lot more value. But there is going to be a general partner risk, and it's a name you don't know. It could be a first time fund or a second fund. But I think this all gets back to the importance of due diligence and what it really truly means, because we do have a huge run up in money that's run into the private equity or private capital space. And Bain had a very interesting study for the first half of this year. And I think over the last 5 years or so, it's been like $6 to $7 trillion has come into the space. So if you have that much money coming in, you need a much bigger exit window on the back end. Not only the exit window not getting any bigger, it's now nailed shut. So there's a lot of money stuck in the system. I think
Sure.
by Bain's estimate, we have 27,000 portfolio companies worth $3 trillion that's stuck there too. I guarantee you they're not all going to clear the market NAV. So there are a lot of important considerations here. There's still tremendous value, tremendous opportunity, but I think you do have to think about manager selection beyond maybe the usual suspects who have had a great run and maybe will continue to as well, but maybe try to make some new friends through due diligence as well.
I love that answer. Very detailed, and I think hitting right at what I was getting to. I'd like to close our conversation today with a little, and feel free if this isn't your area, but can we talk a little bit about agriculture and a little bit about land and how we look at land through the lens of alts and institutional investing? I just kind of like to get your take on any trends or conversations around that.
So, not necessarily my area of expertise, but it is interesting. There are some household names, and I won't mention any of them here, that I think some of your listeners may be surprised to know that they're the biggest farm owners or landowners in the world, or certainly in the U.S. and North America. And then some of these properties, you may be buying, and not so much for the ag play, but maybe there's water rights lying beneath them. And I know there were some cases out in California not that long ago about some of the endowments that got involved in that space as well. But food safety, the need for food in a growing middle class in many parts of the world are going to be critically important. I think, again, for the right investment, could be very interesting. It seems like at cocktail parties, everybody's talking about their latest VC investment. Not so many people are talking about the farmland or timberland investments. And again, that speaks to less players, more inefficiency, and potentially more alpha. So it is an interesting spot we cover in our curriculum, one that I'm by no means even close to being an expert on. But I know it's an area you cover, and it's sort of maybe the heart and soul of this podcast, but one I think investors should be paying more attention to.
Yeah, I agree as well. And I think when you talk about the path less traveled having the most opportunity, I think that resounds very strongly in certain ag places and sectors. And I appreciate that. I guess in closing, I want to thank you so much, Bill, for your time. I've really enjoyed our conversation today. I know our listeners will really enjoy it too. And I just really appreciate you coming out. We're going to make sure we link in our podcast notes to Kaya and your education platforms. And so we'll make sure we hit, all those different things we talked about today. And I really appreciate your time.
Excellent. Thank you. Appreciate it, Craig. Stay well.
Thank you. You too.